This is the Brave New Coin Crypto Conversation, hosted by Andy Pickering.
Hi everyone, Andy Pickering here. I'm your host and welcome to the Crypto Conversation, a Brave New Coin podcast where we talk to the people building the future in the Bitcoin, blockchain, and cryptocurrency space. My guest today is William Quigley. William is the co-founder of Wax, a Web3 ecosystem for gaming and NFTs, and he's also the co-founder of Tether, which most people will be very aware of. Welcome to the show, William.
I'm glad to be here, Andy.
So I think we'll do what we do at the beginning of the show, William. I will invite you to please introduce yourself a little bit more. I'd love to hear about your backstory and the lead up to you getting involved with the likes of Tether and Wax. And yeah, just tell us a bit of your story, please.
I guess I would start by saying I've been trading virtual items for over 20 years. Now, for those in the crypto space for a while, they'll know that Bitcoin really was launched in 2009. So that wasn't 20 years ago, but there was a very robust, and still is a robust market in virtual items, and that's in video game virtual items. And so in the late 1990s, video games started to roll out the concept of allowing people to trade in-game items. Now these things, of course, are just embedded into almost every video game, but at the time, this was a new concept. And shortly after, games like Ultima Online, for those of you in the audience who are a little older, will remember, shortly after those games started to allow people to transfer their virtual items to one another, my partner started a marketplace that allowed people to buy and sell video game virtual items using a digital escrow service. And that market grew to about $10 billion annually. So the secondary market for the buying and selling of video games, virtual items. And he sold that business in 2009. I was involved as a board member and advisor. So I learned a lot about that business, and then as a video game player. After video game virtual items came another type of video game item called skins. And so your audience is probably familiar with skins if they play games. So the difference between a virtual item and a skin is this: a video game virtual item is an item that has in-game utility. It gives you power, it allows you to do certain things, and it's tradable. A skin is a video game virtual item that has no in-game utility. It's strictly for cosmetic purposes. And for reasons maybe we'll get into on this podcast, maybe not, once we saw the arrival of skins, we knew the secondary market would be many times bigger than the market for strict virtual items. And that happened. The secondary market for skins grew to be about 50 billion USD annually, which is pretty darn good, a 5x multiple. And in between those two things, along comes blockchain and Bitcoin. And so I don't know how well it's known by your audience, but a lot of the early people in crypto came from our industry, came from the video game virtual item industry. And the reason is these things look a lot like Bitcoin and other crypto. You can own them, you can trade them, in a barter fashion, you can trade them for cash. That's what our marketplace allowed. They become money substitutes effectively. And when you realize that in many parts of the world, it's very hard for people to have any sort of digital payment system. It seems very commonplace for all of us in the West, the US, Europe, but in a large part of the world, it's hard to get banking. It's hard to trust the banking if you do have it. And it is difficult as an individual to get an account. So if you could instead use video game virtual items, you got a lot of the same benefit. So that's the reason I got excited about Bitcoin was it was just like what I'd been doing with a twist. And the twist, we all know, is that it was decentralized, and that means not controlled by any individual party or company. And the shortcoming of video game virtual items is they only exist in the video game, and the video game companies can either shut your account down, or they can prohibit the transfer, which some games do, prohibit the transfer of items for money, or they just go out of business. So the concept of a decentralized permanent ledger that would allow people to exchange tokens back and forth, that was super appealing to me, and so that was the reason I got excited about it.
Fantastic. Very well said, William. And, you're exactly right in terms of pointing out that a lot of the early, let's say, crypto pioneers did indeed come from some kind of gaming background. I think, famously, Vitalik was a big World of Warcraft guy, I think. And I remember, of course, there was a famous I guess you'd call it a thought experiment, if you like, written by Hal Finney, who is essentially, ground zero in Bitcoin. But he wrote an email about, I think he called them cryptographic trading cards, something like that. But it really, he's talking about the same thing, whether you call them NFTs or portable in-game items. So yeah, fascinating, William. So we'll circle back around some of this stuff, and I'd really like to get your thoughts on kind of because the real problem, as you've identified, of course, is working with the big gaming companies to make those in-game items or skins tradable and portable across different games and the ecosystems. But I imagine this is partly why you've co-founded Wax. So why don't we start to learn a little bit more about what Wax is and what the vision is, what the problems are that you're trying to solve and the solutions that you're bringing.
Yeah, well, I'll start by saying I had a benefit probably that no one else had in the crypto industry when I got involved, which was I had a blueprint for how a similar, very powerful new platform had been adopted and what pieces, what new capabilities were being built for it. And that was the Internet 1.0. I, with two of my partners, started the first consumer internet venture capital firm in the 90s called Idea Lab Capital Partners. And I saw at that time how we started with, we already had the platform, that was the internet, but we started with e-commerce. By being involved in e-commerce, we learned that it's not enough to have an e-commerce site, you need to have customers. So then we realized, we should look around for ad type programs and ad type businesses, and we did that. And then from there, once you bring customers to your e-commerce site, how do they pay? So then we invested in payment technologies. We were the first institutional investors in PayPal. And then we got into analytics and such as we realized, as businesses grew, they would need more of that. So I sort of looked at it the same way with my partner. And I said, look, this thing called Bitcoin's cool. People were starting to talk about you could fork it, and just because, of course, it's open source, and build another thing, use the same kind of approach as Bitcoin was. That would be maybe similar to a Litecoin, or do something completely different. And that's very much like a mod to a game, again, bringing back a gaming reference, where some games allow you to set up your own server and modify the game, maybe change the gravity level or something like that. So looking at it, we came up with we thought it was a 5-year plan. It turned out to be more like a 11-year plan. But we came up with a playbook of what we would do. So we would start with infrastructure related stuff. Obviously, mining would be one of those. And then go into things like chains, maybe start to modify existing chains, and then look at ways for the consumers to interact, wallets and exchanges, custody solutions, and then ultimately new types of tokens, which we weren't really sure what those would be or what the demand would be, but we thought by the time we get there, we'll figure it out. And so that's what we did. Using my venture capital experience, we both invested in a lot of companies, Kraken and Coinbase and Zappo and Bitfury and a whole bunch of other companies that people will remember who've been in crypto for a while, and incubating as well. So part of the incubation project was to tokenize the US dollar. That became known as Tether. And then while we were doing Tether in kind of 2013, 2014, and we can talk about why we did it, we were very interested, remember, in the skins business and video game virtual items business. And our thinking was, if we could put those things on a blockchain, then we couldn't be curtailed by video game companies who had the bad habit of canceling accounts. And we ran the largest video game virtual item marketplace and then the world's largest skins marketplace. So we knew a lot about this business. We knew most game companies weren't that keen to allow people to trade for money, their skins. So we thought we would do that. But when we were looking at the state of blockchain at the time, we realized that there was no way to get any sort of consumer mass market scalability out of existing chains, all the variants of Bitcoin and such. And so we tabled that idea and we just focused on a fungible item like USD. And we built a separate blockchain for that. That was called Mastercoin. So Mastercoin, you don't hear a lot about it now. It got renamed Omni, but Mastercoin was one of the foundational contributions to blockchain because it introduced the concept of putting an intelligent layer on a chain and what you'd call smart contracts. And one of the employees of Mastercoin was this young kid named Vitalik, in fact. So we built Mastercoin, and the very first use case for Mastercoin was actually Tether. And we made one mistake with Mastercoin, and that is we built it on top of Bitcoin. And the Bitcoin core devs didn't understand why anyone would want an intelligent layer in a blockchain. Now, that didn't seem logical to me that they wouldn't understand that, but I had done a lot of telecom investing and I understood how signaling works and and packet switching, how you must have intelligence embedded within the system. It can't just be a dumb pipe, but they weren't as aware of that. They were cryptographic guys. And so while we were struggling to get support from the Bitcoin core devs, Vitalik and Dino and a number of other guys at Mastercoin decided to build a dedicated blockchain that would be really a virtual machine. And they named that Ethereum. My partner and I became I thought we were the largest, but we're the second largest investors in the Ethereum crowd sale, which for people you want to know, it was 2,000 Ethereum for one Bitcoin back in the day. Now Bitcoin was cheaper, but so was Ethereum. It worked out to about 30 cents per Ethereum at the time of based on the price of Bitcoin. And so it was not until about 2017 when a guy named Dan Larimer, and again, a lot of people maybe don't know Dan, but I believe Dan has the record for building the most $1 billion plus market cap blockchains. He's done 4 of them. And his fourth was something called EOS.io, and the idea was to allow real scalability. He thought several thousand transactions a second, and he's gotten pretty close to that, I will say. So when we saw what he was building, we thought, okay, now is the time to do WAX. And the WAX, which stands for Worldwide Asset Exchange, was the idea of taking media files, video, music, game files, and putting them on a blockchain, or at least putting the metadata on the blockchain, because you don't actually store the file itself on a chain. And we thought, if we roll this out, the transaction volume is going to be so high that there's no way it would work on anything but a brand new consensus mechanism, which is what Dan created. We took, because it was an MIT open source license, we took that and we put that into what we called WAX. And then we started calling these files NFTs. And so, from 2017 until really most of the way through 2020, no one cared about NFTs. No one really thought they had much value. And so we were toiling away and, working with brands. I was really trying to get something I had traded when I was a kid, the Topps baseball cards. I was trying to get the Topps company to put their trading cards as NFTs. And it took me 2 years to explain to those guys what a blockchain was and, how this system differed from digital. And at some point we should talk about that, the difference between tokenization and digitization. But eventually they got it. And we launched the Wax Packs, which was 5 NFTs, each NFT a trading card in a pack. And that was like April 2020. And we thought we'd sell them out in like 60 days, and they sold out in like 20 hours. And that was 100,000 NFTs. And from there on, it was just what we all know now. People were jumping into this space. They love the idea of trading these immutable items that you can guarantee they are authentic. And so that became, the primary driver of the Wax blockchain transaction volume. And actually, I should point out, today, Wax has more transaction volume, sometimes more than all blockchains combined, but it's always number one. It does between 20 and 25 million transactions a day. And you really, as I said, you couldn't do that on almost any other chain. So what we set out to build turned out to be useful. And as time goes on, more and more things will get tokenized as NFTs. We can talk more about that and what those will turn into. But, the experiment worked.
Yeah, yes, it certainly did. And well, thank you, William, for going back to the beginning and really explaining your story. Because what's fascinating about it, of course, is you're one of these people who has effectively been around through the various different stages of the internet. Even if we just basically just say, Web1, Web2, and now Web3, then people will kind of understand what that means. And not just around as a user of the internet, but really as a VC, as an investor, as an inside player. So you really do understand the kind of technological shifts that take place. And look, presumably you've done very well, of course, as well. Things like the Ethereum pre-sale. I'd love, though, William, if you could maybe describe, a bit more as to why you see the power and promise and potential of let's just say a Web3 or tokenization. Difference between tokenization and digitization. What the new world of Web3 is going to enable for people, because you clearly have a vision for it. And just before you do that, I do recall, was it William Shatner? He was one of the first, because William, I follow him on Twitter. William from played the Captain Kirk in Star Trek in the original one, and he's been a big supporter of Bitcoin, NFTs, and so on Twitter. And as I recall, he was one of the first guys to release some digital trading cards, and that was on Wax maybe back in 2020 as well, wasn't it?
That's right. Yeah. William Shatner, by the way, he's 91 years old.
Yes.
92 now. Isn't it amazing?
It is.
He is incredibly aware and smart and into technology. And I love the fact that this 90-year-old guy was like, hey, I like what you're doing on Wax. I want to do something cool. And what we did with him is we took photographs that he had since the 1950s that had never been released, and we turned them into NFTs. And the photograph I remember the most was an X-ray of a root canal for that he got from his dentist, like in the 50s, which was pretty cool actually to see that like on the Wax blockchain. So yeah, then Hasbro and Mattel and Funko and a bunch of bands, a lot of brands have been releasing stuff on the Wax blockchain because it scales. And so yeah, I would say we were, as I looked at how we would go about and take advantage of what the blockchain was, I will say I never used the term Web3, and I don't use it because to me it's sort of a nonsense term in that it doesn't whenever I'm on a panel at a conference and I ask people to define it, everybody defines it differently. I personally think the reason the Web3 name came around was because in 2021, venture capitalists still weren't doing much in blockchain. Some of their funds actually prohibit them from investing in blockchain or crypto directly. So one of them finally decided, what if we just got out of the whole blockchain and crypto thing and we just call it Web3? Because, we told our limited partners we did Web1 and we did Web2, we did well, we'll do Web3. And I really saw once that nickname came about, all the VCs jumped in. The problem with it though was, and we've seen over the last 6 months, the results of this was most of those VCs did not have a clue what they were doing. They didn't understand this at all. And one of the benefits of labeling something what it is it sort of forces you to try to comprehend what it is you're doing. And if you say you're a blockchain investor, you better understand how blockchains work. And so I think there's a lot of shenanigans that have been played with crypto and maybe novices to crypto. And as I said, in 2022, a lot of those chickens came home to roost because people were doing things they didn't fully understand. So when I think about what we've been doing, I think of it as blockchain and crypto. And the challenge with blockchain and getting people engaged in blockchain is how esoteric it can come across as. And often, you guys, I think your podcast is really good in this regard, but a lot of people talking about crypto, they use mumbo jumbo, terminology that's not really understandable by the average consumer. And so that becomes off-putting. In fact, I think NFTs drove more users to blockchain related things than anything else up until that time, because people could understand the idea of trading a digital trading card. That made sense to them. But for the most part, people still don't understand how blockchains work and why they're important. And the reason as an investor, you must understand this is very simple, because a blockchain is the worst possible way to do virtually anything, the worst way. It's the reason why we don't use blockchains for most things. However, and the caveat is, there are a few things for which blockchain is ideal, for which it has no substitute. And those things for which blockchains are actually really useful are so transformational and so big that they would justify a $10 trillion market cap for all of crypto, let alone where it is now. And I think sometimes we do a disservice in the crypto community by trying to do things that really don't work so well on blockchains, and then having to accept the criticism that, client server architecture actually is more useful than a blockchain for that. And so I tell people, especially VCs who are thinking of getting into crypto, I say, look, the level at which you will understand blockchain and crypto and business models that are appropriate for that will always be superficial if all you do is buy tokens or invest in the equity of these businesses. What I did during Web 1.0 was I was part of an incubator with our fund, and we were building companies. And we did the same thing with blockchain. We built many companies, many blockchains, many smart contracts and applications. And when you do that, you actually also become a much better investor because you understand why somebody made a certain technical choice. You also understand when maybe some young entrepreneur is doing something that's not going to work. So a little bit of advice to anyone thinking of investing in this sector, go out there and build stuff on it while you're investing. You'll be a much more proficient investor.
Yeah, very, very good advice there, William. Just to change tack, just briefly, you mentioned, I suppose, being, I don't know if it's the right phrase to say that you're a co-founder of Tether, but you were one of the early pioneers of the Tether project. I don't think you're involved anymore, but Tether, kind of rightly or wrongly, there's this kind of you'll be aware that there's a strange narrative around Tether. There's a bit of a mystery, if you like, because there are a lot of people that criticize Tether, and there are a lot of people that obviously use and support Tether. And there's this kind of mystery around whether they're a properly audited project. And, people don't always understand how difficult or simple it should be to audit these projects, and that's kind of it seems to be a recurring issue in blockchain, as we've seen over the last year or so. Blockchains should be a single source of truth, but time and time again, we've seen a lot of effectively centralized crypto companies keep their financial records very opaque, and that has led to some pretty catastrophic collapses over the last 12 months. Don't necessarily need to go deep into that, but just would love to sort of get your take on some of this and Tether.
Sure. I probably have a unique take because I began my career almost 40 years ago. I'm an old guy. I began my career when the savings and loan crisis was going full bore. Now, for those of you maybe outside of the United States, are born after the 1960s, the savings and loans were a type of financial institution in the United States that were focused mostly on originating mortgages and other long-term lending for America. And there were thousands of them around the U.S. And they got into a problem in the 1980s because the savings and loans started to allow borrowers to do speculative real estate investing, particularly in areas like Texas, where there was a lot of oil patch investing because oil had shot up from $3 to $40. Anyway, they all collapsed, or not all of them, but many. And it was, at the time, the financial crisis of the century. By the way, I now know that happens every 7 years. But at the time, that was new to me. And I was a forensic auditor who would be sent in to help understand what the balance sheet of these collapsed S&Ls looked like, and then for the federal government to take them over and ultimately to sell off the assets of any of the S&Ls that had been seized. So I had some experience with auditing. I'm a CPA, and no longer practicing, but was. And so when we now look at something like Tether, so there were 4 people who founded Tether. I should give them all credit. Brock Pierce, Reeve Collins, Jonathan Yantis, and myself. And we founded it in order to have an ability to trade between cryptos efficiently, and in order to have a safe harbor when we got nervous because crypto we felt like was about to crash. Back in the day, every couple of weeks, Bitcoin and its related tokens would just collapse 70, 80%. And if you started to get nervous, it was very complex to get a safe harbor, because the way it used to work was there was only a few exchanges in the world where you could deposit cash. And most of those exchanges only allowed you to trade Bitcoin, buy Bitcoin. They were like buying services. So you would wire money to that exchange or that buying service, buy Bitcoin, and then take the Bitcoin and transfer it to what we used to call alt exchanges. And an alt exchange was where non-Bitcoin related tokens got traded. It was where it was a lot more fun. But those places didn't have any fiat intake or outtake. So if you felt like things were going to get dicey, what you needed to do is sell all of your random tokens for Bitcoin, transfer the Bitcoin back to one of the few places where you could sell the Bitcoin for cash. Now, they weren't depository institutions. So once you transferred it into cash, you had to have it sent to your bank. All that took 7 days. By the time 7 days came by, you wanted to be back into crypto again. So we thought, what if there was a way just to keep a token stable? And we thought about, of course, algorithmic approaches, because those were conceived of in the 70s. But my thinking at the time was this had to be simple. And one of the things I learned when I was a CFO at Disney was consumers pray to the God of convenience, meaning consumers have to really easily understand stuff and be able to easily use it. And this was the opposite of how crypto is working. And so we thought, if we're going to build or launch a token that remains stable, it's got to be really easy to explain. And the easiest way to explain something like this would be, you give us $1, we give you a token. You give us the token, we give you the $1 back. I think that's pretty straightforward. It still took about a year to explain it to the crypto community, but that's a different story. But it was pretty straightforward. And so we did this with Tether, and we did not ever think it would be a smart idea to have an algorithmic token. And I don't know if it's worth describing the 3 types of stablecoins, but I guess I will briefly. So Tether, Circle, these are tokens that are collateralized against fiat, real money off chain in a bank account. Those are pretty darn stable and easy to understand. The second type of stablecoin is a stablecoin collateralized by another token. But here's the key. It's not collateralized by a token that the stablecoin creator made themselves. It's collateralized by Ethereum or Bitcoin or some other token that they don't control. That's very important. The third type of stablecoin, these are the toxic ones, are stablecoins that are collateralized against another token that they themselves issue. That's when you get into trouble. And that, of course, is the story of Terra Luna. So if you do have a token, a stable coin like Tether, and Tether was the first stable coin, the one thing you need is for people to be confident that for every stable coin, for every Tether traded, there's $1 in a bank account somewhere. Now, since it's not on chain, you can't easily just tell people, look at this address to see that it's collateralized. But it's not that hard to get people confident that there is cash somewhere in a bank account. And having been an auditor of banks and S&Ls, I can tell you the easiest line item in the world to audit is cash, because all you have to do is get a confirmation from the bank. So for reasons I'm not clear on, it's never been a priority, I guess I would say, of the owners of Tether today to do very frequent and very clear audits. And as a result, people wonder, is there sufficient dollar-based collateral or other financial collateral, certificates of deposits, government bonds, whatever it is, to support the amount of Tether outstanding. Now, having said that, I'll also say that Tether is the most traded crypto on Earth. It trades somewhere between 20 and 30 trillion USD a year. It is also the most popular token to settle a trade against. More than half of all tokens traded are paired against Tether. And the reason for that, by the way, is most token trading is trying to take advantage of arbitrage. And the only way to arbitrage, which means riskless profits, is for one side of the trading pair to be stable, because otherwise you can't calculate your gain or your loss. And so while there's a lot of criticism leveled against Tether for its lack of transparency into the underlying assets behind it, I'll also say, yet it's the most traded stablecoin, the most traded token of all. So clearly enough people do have confidence in it, even though the transparency could be better.
Yeah, that's exactly right. William, I think I'd agree with that. I'd love to get your perspective on then, we've had this, let's just say the bear market of last year and some fairly catastrophic collapses of some of the, hate to use this word, but the most trusted crypto institutions.
Yeah.
And now, here we are again, perhaps somewhere near the bottom of the cycle, and we move forward afresh. What do you think is likely to happen in terms of perhaps the regulatory environment? Because so much of the future of so many of these different assets does depend on what happens there. I think, Gary Gensler has, I think he suggested that, Bitcoin is a commodity, but him and the SEC seem reluctant to, or they kind of point at everything else as potentially a security, which isn't super helpful. I wonder how you think about all of this and what implications it will have for the likes of NFTs going forward, and can we have a truly decentralized system of these assets in that kind of regulatory environment?
Yeah. Okay. Yeah, I'll try to tackle some of this stuff. Obviously, these are just guesses, because in the realm of blockchain and crypto, there are no experts. There are just students. We're all students of this stuff as it's being built, and we're understanding how it's going to be integrated with the rest of society. So regarding the recent collapses, let me just say this. If you look at it, all of the, whether it's Voyager, Three Arrows, Capital, Celsius, FTX, Genesis, all of these entities have some commonalities. The first is central control. So these are not blockchain, crypto, decentralized entities. These are regular Joe businesses. They're not blockchain any more than Microsoft is blockchain. They just sell products like everybody else, right? So that's very easy and almost understandably hard for, let's say, people who aren't in the crypto sphere to appreciate, because it kind of sounds like, oh, your blockchain businesses, your crypto businesses, they failed. There was fraud. There was not supposed to be. But of course, we know that these were just centralized companies. So the other thing
run by greedy profit motivated humans who got too greedy, really.
Yeah. You and on the greed, I mean, the purpose of most for-profit businesses, of course, to generate a profit. But I guess when we use the word greed, what we're implying there is people started cutting corners and started to ignore risks and concern about the people they were supposed to be taking care of. So the other commonality here is leverage. And at my age, and after, almost 40 years in the financial services industry, I will say, I feel like leverage is the toxin of capitalism. Every time we see an enormous financial dislocation, can't say every time, the majority of the time, leverage plays a role. And that was true in spades this time around. I have to admit, I was totally unaware at the depths of leverage, the extent of leverage, and how deeply intertwined leverage had become in all aspects of these centralized companies. The Bitcoin mining companies were ridiculously levered, 100x. And then, of course, all of these, many of these DeFi-oriented companies, like in particular, the lending businesses. It's very clear when you look at Voyager and Three Arrows and Celsius and Genesis, these were all lending related companies, right? And the patient zero of all of this was Terra Luna. Terra Luna, that stablecoin, blew up. When it blew up, all of these people who were using it to trade, using it in their arbitrage or the attempted arbitrage operations, started to take huge losses. In this case, the biggest one of those was Three Arrows Capital. Three Arrows Capital, a $10 billion hedge fund in Singapore, had borrowed heavily from people or places like Celsius and Genesis, billions of dollars. And of course, Genesis and Celsius got their money to lend from hundreds of thousands, millions of individual retail holders sitting on exchanges like Gemini. So this contagion spread everywhere. But had you not had this leverage, or I think, had you had transparency into how this leverage was being used, I actually think you would have had a lot less people participating in it, because it would have been more clear how reckless it was. So keep in mind, prior to 2021, there was almost no leverage in crypto, almost none. Now, whenever I'm on television talking like on CNBC or whatever, people will make the comparison to the financial crisis. And they'll say, wow, that was all about leverage and, mortgage-backed securities and 100x leverage. And how did we deal with that? Massive amounts of new legislation in the US and Europe, the Dodd-Frank legislation in the United States, a terrible piece of legislation. And so wouldn't that be the right remedy here? To which I say, there's a fundamental difference. And this is it. All of those billions of dollars, hundreds of billions that ultimately have been lost, because as all of these businesses collapsed, people's confidence in crypto collapsed, and so the valuations collapsed. We were at almost 3 trillion total market cap for all crypto in November 2021, and now it's $1 trillion. So we've lost 2 trillion. But did companies around America go bankrupt? Did investors around America go bankrupt? Did millions of people get laid off like what we saw in the financial crisis? No. Did taxpayers have to bail out crypto investors? No. And the reason is because there was no government guaranteed deposits that were used to go into these very over-leveraged positions. That's the good news. By the way, very similar to what happened in the dot-com bubble in 2000. When all of these dot-com companies had high valuations collapsed, it wasn't really even registered on the conscience of the East Coast of America, where all the stock exchanges are, because there was no government bailouts. There was no government guaranteed deposits that had been compromised. So it's very important that everybody understands that. If you are going to have recklessness, and if you're going to have massive collapses, you want to do it the way we did it here, which is, if you take a risk, whether you're informed or not, you bear all the responsibility, and that is not going to be socialized around taxpayers who did not choose to do the same thing. So that's a big difference. Having said that, of course, we will likely get regulation, more regulation than what we have. In some respects, there's some good to that because we've all had to operate as though we live under some regulatory regime because that's the advice we get from legal counsel. And because different agencies, particularly in the United States, the CFTC, the Treasury Department, the IRS, the SEC, they have been trying to apply their rules to areas in crypto, which in some cases may be correct and in some cases seem like an overreach. But whenever I hear the term regulation, I want to struggle a little bit with it and say, well, generically, it doesn't mean a whole heck of a lot. What you need to hear are what are the specific proposals. One proposal I could clearly accept is if you're going to be an exchange in the United States and probably in most of Europe, and you're going to be taking deposits from individuals, non-accredited investors, I think it would be very useful and helpful for that exchange to publish its balance sheet as often as possible. Maybe that's once a quarter, and then get audited once a year. That would be a useful requirement. If you're operating a stable coin, I think it would be useful to have some sort of regulation that would clarify what assets are collateralizing those stable coins. I think we can start there. There will, no matter what, be a lot of KYC, know your customer, and AML, anti-money laundering regs. For the most part, though, I would say all bigger crypto companies already employ KYC and AML standards. And that's just because it's been the risk of not doing so has been very high. And a lot of regulatory bodies around the world have really demanded that crypto companies do that. And even in our skins marketplace, for instance, we did KYC and AML processes, and we had millions of customers. So it's not an overbearing request for some regulatory body to insist on that for crypto companies. And lastly, what I would say is all of these calamities that have struck these centralized blockchain-like businesses will, I think, have the effect of causing a lot more people to look more closely at using decentralized solutions, because not a single one of the decentralized solutions has collapsed due to fraud. There have been compromises due to hacking events, but those are survivable. So I'd say this would be helpful to do a lot more and get a lot more user participation in the decentralized solutions, because those really use all the robust tools of blockchain, which is why we built the stuff in the first place.
Absolutely, William. Very well said. Again, let's start to finish this off then, William. Perhaps just be good to get your thoughts on how you think about, let's say, the next wave of digital collectibles adoption or NFT adoption, if you like. And I think, earlier in the show, you said something to the effect of, it was really NFTs that brought the real first wave of mainstream users into crypto. And I've always said something similar myself, and it's simple, really. I mean, you said it yourself, that there's only so many people that have the time to kind of understand the esoteric but necessary need for a decentralized digital unit of monetary account, such as a Bitcoin or something like that. But if you can put a pretty picture on it and make it a baseball trading card or a beautiful flower, piece of art, whatever you want, a skin for a Batman skin for your video game, then of course that just makes so much more sense to people. So what does the next wave of adoption look like? How is Wax involved in this? Why should people use Wax? And maybe just another piece of the puzzle, if you want to just factor it in somehow. When do we see the big game properties? People like Fortnite, for example. When do they finally embrace blockchain NFTs?
Yeah, and it's of course these are all things, as you can imagine, that I think a lot about, and I've built a lot around. If I could, though, I would like to, I think, provide your listeners with maybe a different way to think about NFTs. So NFTs came into mainstream around things like Topps trading cards and music getting traded, snippets of videos, artwork from lots of different groups. And so the consumer looks at an NFT and says, oh, I get it. It's pretty pictures on the blockchain, whatever that is. And that is would be a limiting way to look at it. And to the extent there are people out there who are listening to this who are interested in becoming entrepreneurs, maybe you are an entrepreneur and you're trying to figure out, how do I take advantage of this technology? I'd give you a way that I tried to do everything since going back 30 years as a VC, which is to really take a more abstract look at a platform and to really understand what it is in its essence. So pictures, images, media files on a chain, those are applications of an NFT, but they're not an NFT. An NFT is a Turing complete computer. That's what an NFT is. It's a Turing complete computer. What I find remarkable about it is it's a computer that you can send to another person, and where the recipient knows at no cost or relatively low cost, at instantly and with no effort on their part, that the underlying software in that computer has not been tampered with, and that is totally exposed and can be inspected to make sure that it only does what it's been programmed to do. Now, when you think about all the things we get today and all the things we use on the internet today, and we have no idea what the underlying code is actually doing, right? And there's a lot of privacy issues and a lot of malware problems that this creates. But the notion of this NFT concept is really appealing. And it's remarkable. The idea that we can send programmable computers with software that we know with certainty only does what it's stated it was going to do, and can be programmed to do anything, including being linked to an image or playing some role in a video game. This is how you should begin to think about NFTs. Because once you get to a point where you can start sending computers to other people and those things can be programmed, you start to go away from digital world, which we've all been in for the last, 40 years or so, to the tokenization world. So one of the fundamental difference between digitization and tokenization is a tokenized asset is one that because of its blockchain properties, it can be imbued with a lot of capabilities like programmability that a digital asset can't. And of course, as we all know about blockchain, a tokenized asset can never be copied. You can make a facsimile of it, take a screenshot, but that is not the genuine article linked to that smart contract. So thinking about NFTs this way will maybe help people sort of broaden what they could actually do with them. Here's my take. I think virtually every industry in the world in the next 10 years is going to employ NFTs because of these powerful traits I've mentioned. Very simple things. Anything that where a company is giving a document that it wants to stipulate has been untampered with, make it an NFT. Any IDs, your driver's license, your membership pass, your passport, those will all be NFTs. And then, of course, within video games, Video game companies are ultimately going to uh, incorporate them. I think it's going to take a lot longer than people think. And mainly the reason for that is, remember, I've been trading video game virtual items for over 20 years. Uh, I've educated a lot of video game companies about why the existence of a secondary market creates a much more robust primary market, which is what they're selling to their video game players. But even with that knowledge, most video game companies do not like secondary markets. They have I kind of think a primitive view that the secondary market somehow dilutes the primary market, that people are less likely to buy in the primary because there's an active secondary. Even though we all have very good examples in the real world, well, that's not the case. The clothing market, there's many sites you can go to trade used clothes. There's many sites you can go to trade used consumer goods, eBay being an example. And that doesn't take away, or sneakers, that doesn't take away from the markets of someone like Nike or from Apple, because you can buy and sell their phone in the secondary market. But the thing that we've focused a lot on, in fact, we were the first to do it at Wax, is linking the NFTs to the real world. We call these things virals, which stands for, it's VIRL. IRL in text language means in real life. And then the V I put in front of IRL is for virtual. So virtual in real life NFTs, viral NFTs. And these are NFTs, particularly consumer related NFTs, that are linked to a real world consumer product. In 2017, we tokenized sneakers, and we started allowing people to trade the tokenized version of the real world item. And if you wanted to, at some point, get the real world item, you would go into the wallet and say, I want to redeem it, and it would get sent to whatever address you want to. I believe many of the world's consumer products will be tokenized and traded as NFTs, maybe in the next 10 years. And there's enormously good reasons for doing that. One is that, and I've educated a lot of consumer products companies about this, a lot of consumer products companies are not aware of how big the secondary market is for their products. And it's also quite wasteful and not really climate friendly. A lot of people buy items, hot limited edition items. You've got companies like Supreme that sell limited edition items. Nike distributes limited edition sneakers. And then the people who buy them are not the intended end user. They just go list them for sale on another secondary market. And then when that guy buys it, they pack it up and they ship it to that guy. And that guy might not really use it. He just wants to sell it in the secondary market. So having a digital twin of the real world item that you can trade until the person who actually wants the physical good redeems it is actually a really nice use of the NFT concept, and one that I think is going to be very broadly used. Obviously, the last one I'll mention is augmented reality. I think it's pretty obvious to some of us that augmented reality is going to have a very core part in the NFT space. In fact, I think the revenue model of augmented reality businesses, many of them will be NFTs. And when will augmented reality at the consumer level be useful enough, cheap, affordable, scalable products? I suspect it's post 2025, but 3 years, 4 years from now, that might even trigger the next NFT boom, is the rise of augmented reality NFTs. So those are some things, I guess, to think about when it comes to the future of NFTs.
Fantastic. Thank you for sharing your thoughts, William. Very much agree with all of that. A quick shout out to the Jadu team. I don't know if you're aware of the Jadu community, but I've got a Jadu NFT, but they're very much on the forefront of doing some really cool stuff with AR. And it's like, because the Pokemon AR game from, how many years ago was that now? Just seems crazy that we don't have the NFT equivalent, but I know there are many different teams working on it. It is just a matter of time. But look, I could talk to you all day, William. I've really, really enjoyed hearing your perspectives today. Thank you so much for sharing them with myself and the audience. Let's close this down. Please just tell people where they can go to find you on Twitter, and if they want to look more at what you're doing with Wax and get involved, what's the best way for them to do that?
Sure. Wax has a lot of developer tools for people to launch. In fact, I think it's probably the easiest and cheapest platform to use if you want to do anything in the NFT space or video game space. And that's at Wax, WAX.io. And the Wax Cloud wallet is the most used wallet for NFTs. I think we have over 10 million users now on the Wax Cloud wallet. Very easy to use. And then for me, on Twitter, I'm at William E. Quigley. So at William E. Quigley is where you'd find me.
Fantastic. I'm following you already, William. All right. Well, hey, thank you once again for coming on the show, William. All the best, and bye for now.
Thank you. I enjoyed it.
All right. There you go. That was William Quigley from Wax. Man, how good was it? Just to sit back and listen to the very interesting perspectives that William had. So I very, very much enjoyed that. It's good when you can just kind of sit back and let a guest really express themselves, and I feel like we could do that with William. So yeah, a great listen. I hope you enjoyed that, and if you're still listening here at the end of the show, I presume you did. If you are still listening at the end of the show here, please do make sure you are subscribed to the Crypto Conversation in whatever podcast app you are using. Give us a nice review, a rating in Spotify, Apple iTunes, all that good stuff. Hey, thanks for listening, team. This was the Crypto Conversation for Brave New Coin. See ya.